2 verse 24. Welcome to class, Mr. Kehinde. So we have been waiting for you. So without further waiting or for the next person or other students, let's just start the class because we are 15 minutes behind the schedule. So today we will continue from where we stopped in the last class. In the last class, we were able to look at the um, adjustment of final account. So today we'll be looking at the adjustments that relates to stock, that relates to stock and what you call inventory. Popularly, inventory is an item that is being found under the um, current asset. So how do we account for it? Our take home on this topic is number one, to know what inventory means. Number two, how they are being measured. Number three is to know how they are being recorded. Those are our take home, our objective for this class for today. And inventory have a standard under the IAS2. So IAS2 is inventory, is the standard that explains how things are expected to be done in regards to inventory. It gives the definitions, it gives the measurement, the coverage, it gives the initial measurement, the subscription measurement, the disclosures. It gives us how we need to account for this. So for your own, at this level, what you need, we are going to give you what you need to know. So for that level, may advance it as it goes on. So IAS2 inventory, according to the IAS2, which is International Accounting Standard, that's the full meaning for IAS, International Financial Standard, Accounting Standard, sorry. So inventory means a tangible property head. So it can be number one for sales, for ordinary course of business. It can be in the process of production for such sales, or it can be for consumption in the production of goods and services for sales. What they are saying is this, that inventory can actually be a group of items that you had majorly for resales, majorly because you are into trading and you purchase an item pending for you to sell them out. That's the example of what an inventory. So that inventory cannot be, as another example also is that probably you purchase some materials and you want to work on the material. When you now work on the material, you are going to sell the material that you have worked on. That's another my inventory. So inventory can actually classify into three parts. It can be classified into three parts. So we have raw material and components. The raw material it means that these are the goods, they are the inventory that you purchase to undergo some conversion. It means that the way you purchase, you're not going to sell it that way. You are going to work on it to give a specific result. That's raw material. Example of it, let's say flour. You purchase a flour, you work on it, they give you bread. Bread is what is the finished goods there. That's it. So we have raw material, we have work in progress, and we have finished goods. Raw material, fresh, you need to work on it. Work in progress, we have started working on the raw material, but you are yet to finish it. So by the time you are closing your financial year, it's not yet a finished goods. We now have finished goods. Finished goods are goods that are being given to the final consumer. So like I said, example, let me clarify. We have raw material and component. So we have raw material can be, let's say, bread, flour. The finished goods should be bread. So the flour is the part of our raw material that we're going to use. Sugar and the likes. Those are our raw material. When we mix them, at the end of the day, we have mixed this particular flour, but we have not yet baked it, but we are closing for that month. That mixed flour is what we classify as work in progress, because we are still working on it. It's no longer raw material, because we have started working on the raw material to give us our finished goods. So it's in between the finished goods and the raw material. That's work in progress. Then we now have finished goods. This is very, very important for us to know this, because people that are in manufacturing company are the one that actually would have a lot of things to do on these three types of inventory. And it means that because the way we are going to cost them, the amount attached to each of these inventory is different from each other. So under the manufacturing sector, They have the raw material, they have component, they have stores, semi-stores, they have the work in progress, they have finished goods. But if it's for trading inventory are what we call finished goods because they are all about finished. Everything they buy, they purchase item and they resell it. So that's finished goods. So if we flash back to secondary school, when we did there's a particular account that we prepared there. We call it manufacturing, trading, and profit and loss account. You see, that manufacturing account is actually the one that address the raw material. When the raw material has been worked on to give us the finished goods. Is that finished goods that transfer to the trading account? So that's why you see that the trading account inventory primarily consists of finished goods. So I'm just trying to link the idea so that you know how this appears. Okay, so the objective why we need to know the inventory valuation, because at the end of the period, we need to know, okay, we have so material. What is the cost that we're going to attach to the material? How do we even record material? The flour that we issued out, how many bags do we issue it out? How do we record it? What is the standard saying about how we are going to recognize the inventory in our financial statement? So, objective of the inventory valuation, determination of income. A major objective of inventory valuation is the proper determination of income through the process of matching appropriate costs against revenue. Now, what that closing inventory at the end of the period, probably in monthly or yearly, if you are doing for the year, then you count your inventory. You need to know the total inventory that you have left, because this total inventory will affect your profit in one way or the other. If you overstate your inventory, your profit will go up. But if you understate it also, it will go down, because you are saying that you have an item that you have actually sold. So it means that you have what? You are able to cost down your cost and you are able to increase your sales. And closing stock is normally found under cost of sales in profit or loss account. If you remember when you started the class, I said that not this one, I think the previous classes. So I said that sales minus cost of sales will give us our gross profit. And cost of sales comprises of some elements in them. And I say one of it is opening stock, that's opening inventory. The other one is purchases. Then another one is what we call return outward. Another one, what we call is closing stock. That closing stock is done at the end of the period and is used to reduce the amount of cost of goods available to our sales. So if you misstate it at that point, it means that it's going to affect your profit. And if it's affecting your profit, the information there might actually be misleading. That may be misleading to the person that is using the financial statement to make economic decision. So another reason, another objective for inventory valuation is to determine our financial position. The financial position actually is what is the one popularly known as balance sheet before. And it's help us to show the financial position of a company at a particular point in time. If inventory is stated wrongly in financial position, it means that it will be interpreting the financial position wrongly as well, because closing stock is found under current asset in statement of financial position. So when you know that our statement of profit or loss account will be affected if you do wrong by inventory. Also, statement of financial position also will be affected if we are not careful when we evaluate reviewing our inventory, valuing our inventory. It will also affect our statement of financial position. Then the auditors and the management need to pay a good attention to inventory valuation and also management. because you are easily converting your cash into a form of inventory. So the same way you give proper control for your cash should be the same way you give proper control for your inventory. That's why I call it current asset, because they are easily convertible to cash within short period of time. Now, method of recording inventory. We have two methods of recording inventory according to IS2. And one is periodic inventory system. Two, perpetual inventory system. Now, recording. We are talking about how we record transaction. How do we document transaction that regards to inventory? Whenever you hear inventory is stock, okay, please. So it's possible I'm actually using it interchangeably, but introduction of IFRS move it away from stock to inventory. That's why the name is now inventory, no longer stock. Okay, so let's talk. The first one is periodic inventory system. Periodic inventory system is a system that is used to account for inventory at the end of the period. That's end year system. Another name for it is end year system, periodic inventory system, end year system. It means that when stock are being, or when you receive stock, when you issue stock, those items, two accounts will be involved. The purchase account will be involved, and also the payable or the cash account will be involved. Those are the two accounts involved. So inventory, if you want to know, anytime you have opening stock, you have your inventory account. Inventory account, we have your opening stock. Then another item that your inventory account is going to have is your closing stock. And that closing stock can only be gotten when the independent person now take physical counting of the inventory. So the auditor, independent person, will come to that place and do physical counting. So what the person now sees there is what he's going to use to validate or to value the inventory that the organization have at a particular point in time. That's periodic. I explained. Periodic inventory system deals with anything purchase, they debit the purchase account, they credit payable or bank accounts. So inventory record is being done at the end of the period. So they now count, okay, how many things do we have at the end of the period? They count it together, then they record it in the inventory account. The idea there is this, that the purchase account and the opening inventory will be represented in our trial balance, because the addition of these two will give us the total inventory we have at hand. So our purchase account will be written off to cost of sales. Cost of sales, that's COS. Our purchase account will be written off there. Then for the closing inventory, the double entry for the closing inventory under periodic inventory system will now be, we are going to credit our cost of sales and debit our inventory account. I will explain that before we state the figure. When it comes to the periodic inventory system, anytime we purchase item, we debit the purchase account and we credit the payable or bank account. Then at the end of the period, when we take stock taking, we will now, with that figure, we convert it in quantity, based on the concept says. The concept says anything that was monetary concept, anything that does not have value will not be what? Or should not be found in our financial statement. So when we are done with the stock taking, we value it. We are going to get to how we value inventory. Once we value it, then we will now debit the current asset, inventory asset account, which is found under statement of financial position. Then we will now credit cost of sales. which is found under statement of profit or loss account. Now, for the perpetual inventory system, this system provides as running records of inventory on hand, because under this method, stock registers are maintained, which will give the inventory balance at any time desired. This method is used by an organization to ascertain the level of their inventory at a particular point in time. It means that there's a record that is being kept apart from what? Apart from the normal purchases, that at the point in time, we can ascertain the total inventory that we have and the what on the inventory. Periodic, we can ascertain is at the end of the year, you just what? You just gather everything together. You count everything together and value it. Also, if there's any loss, you won't know under periodic, because you don't know the total amount you purchased. All what you did is just to value the inventory that you have at the end of the period. But perpetual inventory is not like that. Perpetual inventory monitors and keeps appropriate records of inventory that comes in and goes out. So at a particular point in time, you can ascertain the total inventory that you have. It helps us to what? To reduce loss. It helps us to identify loss on time and to reduce it by putting in some controls. That's perpetual what? Inventory system. So some controls will be put in place, because when you know that, oh, fine, my record says I should have 20,000 units of particular item, and you want to sell that 20,000 units of that item, but they are not telling you that you don't have that 20,000 units. What you have is 15,000 units, and you know on your record already that you're expected to have 20. So with a glance, you can tell that something is wrong. So you can easily what? Put some measurement in it to reduce loss before it now turns to a big issue. Because at the end of the month, if you are waiting at the end of the year, maybe what you expect to have noticed, maybe 5,000 units that is missing in January that you should have noticed, you are unable to notice it, then another 10,000 now comes up, another 10,000 now comes up, 20,000 units, everything now added up to like 100 units of item missing. So perpetual help us to address that concern. Now, under the perpetual inventory system, it makes use of what we call the inventory account. There is no purchase account. It makes use of inventory account. So whenever we purchase an item, an inventory, we debit the inventory account, then we credit when we credit the payable or bank account. That is the double entry as regarded to what? To perpetual inventory system. So it makes use of inventory ledger as against the periodic that makes use of purchase ledger. Okay. So let's question one. Let's see the question one. FCA Trading had opening inventory of 20,000. Purchases during the year were 60,000 naira. Closing inventory at the end of year 2 was 24,000 naira. At the year end of the following entries, the following entries are necessary. Show the accounting procedure using the two methods. So this question is telling us that fine, we have this transaction. They now ask us as the accountant that, okay, if we are using the first method, which is periodic, how are we going to account for it? And if we are using the second method, which is perpetual, how are we going to account for it? So now let's do that, and let's say it will affect our financial statement. So first one, let's start with periodic. So for periodic, it says that our opening inventory is 20,000. And that opening inventory of 20,000 will be found under inventory account as opening balance. An inventory account is an account that falls under asset, current asset. And asset have debit balance. So it means that our opening balance of inventory we will find under the debit side. So we have opening balance. So we have, okay, let's keep it this way. So we have the opening balance to be 20,000. Now, purchases during the year, we are 60,000. So they make purchase during the year of 60,000. So under periodic, the account that we affected will be the purchase account and the bank account or payables account. That are the two accounts that will be affected. So we come up here and we put bank of how much? 60,000, because it's bank that is giving in cash. So the second leg we go to what? Our bank account on the credit side. Now the closing inventory at the end of year 2 was 24,000. So now give us the closing inventory to be 24,000. They didn't give us any movement. They only told us that what? That our closing inventory is 24,000. So what we need to do here is to now put our closing inventory, which is our closing balance. Our closing balance is what? 24,000. Now that we have that, then we need to write off. We need to do some things, and we need to write off some item. For purchase account, what we need to do for purchase account is to write off that balance to cost of sales. Because it's cost of sales, we need the figure under cost of sales to and derive the total cost of sales that will be used to reduce our sales or our revenue. So we have this to be what? Cost of sales. Cost of sales will be 60,000. Then we go to cost of sales account. Cost of sales account, we put it there here. So we have purchase. Purchase to be 60,000. So for inventory account, we have opening stock of what? Of 20,000 under inventory. So at the beginning of the year, we are going to make use of that 20. So it's going to be part of our cost of sales. So we need to take it out from what? From our inventory. So we come on the other side, we put cost of sales, because that is the account that is going to. We are taking the 20,000 naira, the 20,000 naira of inventory from the inventory account down to cost of sales account. So we put that 20,000 naira here. 20,000. So we could go under cost of sales. Under cost of sales, we put opening what? Opening balance. Opening balance of 20,000. So after we have the opening balance of 20,000, the next thing for us now is to now what? Close our account. So now that inventory account that we have there, we have to close it. So if you want to close it, it will now be the closing balance is 24. So the other side of it will now give us what? The closing balance, which is what we are going to take to our cost of sales as well. When talking about closing balance is found on the opposite side, or that be on the credit side for inventory account. So we have that 20,000. Our closing balance was derived at the end of the year when we did our stock counting of 24,000. So now the debit side is lower compared to the credit side. And that is the difference of what? That is the cost of sales. So you need to take that difference to our cost of sales account, which is what? The closing inventory. Remember, I told you that the entry for closing stock, whenever we find it, whenever you notice it, is that we are going to debit our inventory account, then we are going to credit our cost of sales account. That's what we are going. That's what the entry. So we are debiting this account to not be cost of sales. Cost of sales. That at the end of the year, we are finding it to be what? That's closing figure. Closing figure. We are finding it to be 24,000. 24,000. So we come here under the cost of sales, we put what? Closing inventory. We put closing inventory to be 24,000. Now that we have put closing inventory to be 24,000, we go back to our inventory account because I think that's the all double entry. So our debit side will now be 20,000 plus 24,000 will give us 44,000. And the other side also will go what? 44,000. Then we come to our cost of sales. Our cost of sales now is that the debit side, we have opening balance there to be 20,000. We have purchase to be 60,000. So the total there is 80,000. So now we need to balance out. The other side, credit side, all what we have there is the closing inventory, because the closing inventory, we are going to use it to reduce the total inventory that we have purchased in the year and the one also that we started with. So that now the difference is what we call the balance carried down, and that will be if you press your calculator, 80,000 minus 80,000 minus 24,000 will give us 56,000. 56,000. What this means is that our cost of sales, what this means is that our cost of sales at that moment for that year is 56,000. Is 56,000. Now let me just load an illustration to say this. I have an item in inventory that worth 20,000 naira with me. That's 20,000 naira. I purchased another 60,000 naira to it. That's what the total inventory I have with me is 80,000. So at the end of the year, I have 24,000 left. Remember, I have only opening balance of 20,000. I purchased, I added to it to what? To 60,000 to make it 80,000. Now I am now having 24,000 naira left. So my 80,000 minus my 24,000 will give my 56,000. This my 56,000 is the cost of what? Is the cost of item that I've let go, I've sold off. So the match saying that match the related expenses, or match the expense to the related revenue. So if my revenue is now, let's say my revenue is now 70,000. I'm not saying that for me to how I generated that 70,000 naira is because I let go of some inventory worth 56,000 naira. So the difference between that 70,000 and 56,000 naira will now be my gross profit. So if you do the mathematics, you'll be okay. Then the reason why what we are now doing is that we are bringing the mathematics to accounting concepts, to accounting way of presenting it. That, okay, this is a mathematical form, but in an accounting form, this is what we are presenting, and this is how it's related, and the name that is being given to each figure. Now, under the perpetual, like I said, the perpetual is going to affect, what you are going to have is inventory account. That's what you are going to have, inventory account. So every item, we are not going to have purchase account. Every purchases, every return inward, every return outward will eat your inventory account. It will eat your inventory account. So we have this inventory account. The total business opening or the opening balance. The opening balance. The opening balance was 20,000. So we have it inventory here to be 20,000. Then they make purchase. They make purchase. Now, once they make purchase, what the account that is going to affect is that your payable or your bank account is going to be affected. Your inventory account will be the next attempt to what to affect. So you come back here, purchase. So you have your bank, your purchase of what 60,000. That's what we are going to have here. Your purchase of what of 60,000. Then after that, they now told you that you have a balance. Your closing balance is what is 24,000. So you come down here and put your closing balance. Your closing balance will be 24,000. The left-hand side is 80,000. The right-hand side is 24,000. So it means there is difference. Now, how do you do that difference? 80,000 minus 4,000 will give us 56,000. Now that difference, the name of the difference is what we call cost of sales. The difference is the cost of sales, which means under the perpetual figure, the balancing figure in inventory account is what is the cost of sales if given the closing balance. If given the closing balance, there are times that they are expected to calculate your closing balance. So if you add this 20,000 naira together with the 60,000, it gives us 80,000. At the same time, for 56,000 plus 24,000 also will give us 80,000. That's what we have done. So we have actually what under the perpetual, there's no purchase account. What we have is what is inventory account. But under the periodic, we have the inventory account and we have the what? We have the purchase account and we have the cost of sales. Those are the two accounts that relate. Also bank or payables. Purchases, bank or payables, they relate with each other. Then the balance is being written off to where? To the cost of sales account. So it's from there we can get our total cost of sales that we are going to use to reduce our revenue in order for us to get our gross profit. Now let's look at question. Only had opening inventory of 100,000. Purchases during the year were 500,000. Inventory with a cost of 18,000 was returned to a supplier. One of the purchases in the above amount was subject to an express delivery fee, which cost the company an extra 15,000 in addition to the above amount. Oniyale sold goods during the year, which had cost 520,000. Goods which had cost 20,000 were returned to the company. Just before the year end, goods which had cost 5,000 were found to have been damaged while being handled by Oniyale staff. What are the entries necessary during the period under perpetual method? So they're telling us that using the perpetual method, we should carry out the accounting treatment for this illustration given to us. So we have our inventory account open, our T format. This is what we call T format. Vertical format is when you don't see the T format, or what you see is it in colonial order. Column order. So we have the column. So now let's do this. So we have Oniyale had opening inventory of what 100,000. So is an account is an asset account. So an asset account have what debit opening account. So we have balance opening balance. We have that value to be what 100,000. Purchases during the year, we are what? 500,000. So it purchase account during the year. So the entry for that purchase of our account is that we are going to debit the inventory account, then credit our bank or payables account. That's what we are going to do. So we come down here and put bank 500,000. Inventory with a cost of 18,000 was returned to a supplier. So we have inventory of what? 18,000 that was returned to the supplier. So what we are going to do here is that we are going to reduce it. And how do we reduce inventory? We credit it. We credit the figure. So we put the figure on the right-hand side of the T format. So we have this to be what you call inventory, of course, was returned by supplier. So we have this to be what? Suppliers return. Suppliers return. And that was the sum of what? 18,000. Suppliers return. That's what? 18,000. 18,000. Then after when we are done with that, then we move to the okay. Let's move to the next one. The next one says that inventory with the cost of 80,000 was returned to a supplier. Okay. One of the purchases in the above amount was subject to an express delivery, which cost the company an extra 15,000. Okay, these are a delivery fee. Now, delivery fee is this. When we get there, I'm going to explain this. Delivery fee is part of the cost of inventory. So we are going to add it to the what? To the cost to the inventory account. When we move further, how we cost, they will see the cost of inventory. How do we attach cost to the item that we purchase? So for delivery fee is what is a freight fee is being added to the what? To the inventory cost. So for us, we put it under the what? Under the debit side. So we have delivery fee there, or the name of the account that you call it in your organization. It's set up in your organization. We have that to be what? To be 15,000. After to be 15,000, the second leg we go to where? The second leg we go to our bank account because it's bank that is giving. So we have only yearly sold goods during the year which had cost 520,000. So yearly sold goods during the period, it cost them 520,000. So we have this cost of sales. So we have cost of sales. So the cost of you need to reduce the cost of sales. The cost of sales here is what? Is 520,000. So we have 520,000. That was the cost of sales. So the second leg also we find under what? Under the cost of goods sold or cost of sales. Yeah. Okay. Then after that, we have good which at cost 20,000 we are returned to the company. You know, we have actually made sales before. Now they have returned it back to us. It means that an inventory that we are giving out is coming back to us. It means our inventory will increase. So once our inventory increase, you do what? You debit the account. So you come back here and put return. Return. And that will be what? 20,000. Returning inward. The second leg we will find under where? Under the return inward account. Okay. So after that, we are move on. Now looking at that, we have that under the just before the year end, goods which at cost 5,000 were found to have been damaged. So that's what? That's normal loss. They are found to have been damaged. That's normal loss. Now, for treatment of normal loss is that we are going to credit this one with normal loss, then we are going to debit our cost of sales with that normal loss. So normal loss. We have our normal loss to be what? To be 5,000. We have that to be 5,000. Then after that, we have what we got. What else we have? I think that's all. So that's what we have here. So Oniyale had opening inventory. So we did that. We opened the inventory of 100,000. Then the purchases as well. They made purchases. So our payables or our bank will be the what? The other angle that we're going to what? Debit. Then after that, what else there? They make an inventory with the cost of 80,000 was returned. So once it was returned, it means that it's going to affect, if it's receivables, it's going to reduce our what? Our receivables. As it also is going to reduce our sales. So the second leg also now inventory. You have to reduce our inventory. So it's going to work supplier return credit it, which was 18,000. So supplier return 18,000 credit. The second leg will go to where? To our receivables. So sorry, the second leg will go to our suppliers return account. Is that amount that we are going to use to reduce our sales. So the other one that we have there is what? Return inward. Now the return inward, for return inward, we have this to be 20,000. Now inventory account. Okay, okay. Inventory account. Okay, let me explain this. Let me quickly explain this for better understanding. Let me just, if we have a pen and a jotter there, please document this down so that you can understand it better. So now, for opening stock, what you are going to do, you are going to ping your opening stock in your inventory account to be debit side. That's good. For any item that you sold, if you make sales for any item, then you're going to credit your inventory account with that cost of that item. Then the second leg will go to your cost of sales. Your second leg will go to your cost of sales. Now, if they return any item that you have sold before, then it means that you are going to, your inventory account is involved, your cost of sales also is involved. So what you're going to do is you are going to credit your inventory account. So goods return, the return is to you, you are going to debit your inventory account, then you are going to credit your cost of sales. But if you are the one returning goods outward to them, you are going to credit, you are returning to your supplier, your vendors, you are going to credit inventory accounts, then you are going to debit cost of sales accounts. Please, you need to know that. Very, very important. That's the second leg for that. Then your normal loss, anytime you have your normal loss, what you are going to do is that you are going to, firstly, you are going to invent on your inventory account, you're going to credit your inventory account, then you are going to debit your cost of sales account. If you have abnormal loss as well, you are going to credit your inventory account because you need to reduce your inventory account. Then you will debit cost of sales or cost of goods sold. Now, I believe we have captured that. So going forward, let's continue with the class. So now on our debit side, if we add everything together, if we press our calculator and we add everything together, it will give us 100,000 plus 500,000, that's 600,000. 600,000 plus 15,000, that's 615, plus 20,000, that will give us 635,000. So we move to the other side. If we add everything together, that will give us 18,000 plus 520, that's 538 plus 5, that's 543. Now, 543 is lower compared to 635. So minus 635 from 8 will give us 92,000. So our closing stock is what? Our closing stock is, our closing stock is what? Is 92,000. So we have that to be what? Our closing balance. That's our closing stock. That is the amount that will be taken, that will be represented on our financial position and also taken to the cost of goods, our cost of goods sold. So we have that. So our balancing figure here will be what? 635. That's what. That's how we record for Perpetua. That's where we record for Perpetua. Now let me highlight this, what I said earlier, so that it will be very clear for us. Now, if we make sales under perpetual, if we make sales under perpetual, so let's say sales, what you do is you debit, you first of all debit your receivables account, then you credit. After that, you credit your what? Your revenue account or your sales account. Revenue or sales account. Now, and when you are done with that, under perpetual, then you need to what? You need to make the effects on your account. So what you do is you come down here, you debit is sales. So you debit your cost of sales or cost of goods sold. Then you credit inventory to reduce inventory. You credit your inventory with the what? With the cost your inventory. Now, if there is a goods, if you return goods to your vendor, if you return goods to your vendor, so we have, okay, goods returned to supplier. Goods returned to supplier. So when you have goods returned to supplier, you first of all debit your what? Your supplier account. So your, let's say, payables account. Payables account. So when you credit your debit your payables account, you now credit what? You credit your event no. So okay, the first leg, what we did actually, what, whenever you purchase your inventory account, receive it. Then so when anytime is actually when you return it also, your payable account is reduced and you credit your inventory account. Inventory account. So for goods returned by customer, sorry, this should go to return inward. Return inward. Return inward. So for the second leg now is you debit your inventory, cost of sales, then you credit your inventory because you are reducing your inventory. So you credit your what? Your inventory. For goods returned, by customer, you debit. That means you have to reduce goods returned by customer. So when you make sales initially, what did you do? Your sales, your return inward. Sorry, when you make sales, you carry your sales and you debit your receivable. So you just want to reverse it now. So how do you reverse it? You debit your sales, your return. Sorry, you debit your return outward, and you credit your receivables. Then after that, you debit because customer will return it back to you, so your inventory will increase. So you debit your inventory. inventory, then you credit your cost of sales. Okay, so that's the what? So that's the double entry under the perpetual. That's double entry under the perpetual account. So let's move forward. So method of valuation of inventory. So after we are done with that, we move to method of valuation of inventory. Now, the valuation of inventory can be extremely important for financial reporting because the valuation affects cost of sales, profits, and total asset value in the statement of financial position, just as we have stated above. Inventory must be measured in what lower between the word cost and net realizable value. Please, is very, very important. Inventory, you cannot overstate your inventory. So inventory is always measured and recorded in our financial statement, but the lower between the cost and the net realizable value, which is what NRV. That is lower, the one that is lower between the cost and net realizable value. So now let's look at the cost. When we look at the cost, how do we measure cost? Then we look at how to measure net realizable value. So cost of inventory, according to IAS2 and IAS10, which is PPE, actually what have the similar way of recording cost of an asset and cost of inventory. So according to IAS2, in historical cost is the aggregate of what? Cost of purchase, cost of conversion, that we are converting, cost of conversion, and other costs incurred in the normal cost of business in bringing the inventory to their present location and condition. It means that every cost that you have incurred when you purchase it to bring it to that particular position that you are going to sell it off, that cost is regarded that what will be added together and be used to value the inventory that you have in your record. Then the valuation of inventory at cost will be in what? Consonant with the realization concept. Talking about that when you buy a product, the purchase price or the listed price less the trade discount given to you, plus every other cost you incur to make the inventory available for sales. To make the inventory available for sales. So, for example, if you are a trader, you went to the market to purchase an item, that cost of you purchasing the item is number one. You must add your transportation fee to it as well. That's number two. Any cost that you incur from that market down to your what, down to your shop will be added together. Even when you have an helper in the market that helps you to lift those goods, is also what is also allowed to be added to the cost of the what, of the asset, of the inventory, before you can now say this is the total cost of me purchasing this inventory. That's what the standard is saying, that every cost that you incur, you be what added together. And if you are a manufacturer and you what, the cost that you incur to transform the raw material into finished goods will be added together. We call it then what? Direct and indirect cost. In case you are doing MI, this will be very straight. We have what we call the what? We have variable cost and fixed cost. Variable costs are costs that relate to level of activities, while fixed costs are costs that does not change irrespective of level in activities. Then it means that every cost that you have now incurred for you, we have what we call the direct labor, we have what we call the direct material, we have what we call the absorption or overhead. These are the costs that you have incurred to transform the raw material to finished goods. It means that if you are not transforming the raw material to finished goods, these costs will not be incurred. So all those costs are added together to give you your cost of production. If you remember and you flash back to your what, to your Simplify or back to your Sunday school, when we did what we call manufacturing account, you know, when we started with what, raw material. After that, we look at direct cost. We added them together to give us prime cost. Then after that, we look at what, indirect cost of what, our overhead. The addition of all this together, including our work in progress, the difference between the opening stock of work in progress and closing stock, we gave us what we know as cost of production. That cost of production is what we recognize or we reference under the trading accounts. So it's the same thing that we are doing under the IAS 2. So it's just a way to explain it then under IAS 2. Now, let's look at question 3. Question 3 says, Kumon Customer Electrics, that KCE, buys goods from an overseas supplier. It has recently taken delivery of 1,000 units of component X. So the delivery of what? Component X is 1,000. So they have taken 1,000 units of component X. The quoted price of component X was 1,200 per unit, but KCE has negotiated a trade discount of what? 5% due to the size of the order. Because it's buying in large size, you have what? You have opportunity to negotiate. That's trade discount. So they gave him a trade discount of 5%. The supplier offers an early settlement discount of 2% for payment within 30 days, and KCE intends to achieve this. Import duties of 60 naira per unit must be paid before the goods are released through custom. Once the goods are released through custom, KCE must pay a delivery cost of 5,000 to have the component taken to its warehouse. So you are required to calculate the cost of inventory. So the first thing, before we go to calculation, let us try to know the costs that are relevant for us. So with the first one we have is we purchase a unit of 1,000 units, okay? So, and the quoted price is 1,200 naira per unit. But we are giving trade discounts of 5%. Now, when we are listing, I said earlier that the purchase price will now be what? Listed price minus trade discount. It will be listed price minus trade discount because you didn't pay for that trade discount. So you are not going to recognize that trade discount in your for cost of inventory. The supplier offers an early settlement discount of 2%. Now, at this moment, you don't know if you are going to enjoy it or not. It is not fully ascertained if you are going to take advantage of that 2% or not. So that 2% will not be used to reduce our cost of inventory. It will not be relevant or used to reduce our cost of inventory at the moment. But if later on, in order to take advantage of it, it will not be used to reduce the inventory later. But for this calculation, for us to know our cost of inventory, it will not be recognized. Import duties, 60 naira per unit, must be paid before the goods are released through custom. That is a relevant cost. It will be added to the cost of what? It will be added to our purchase price to give us our total cost of what? Inventory. Now, once the goods are released through custom, KCE must pay a delivery cost. If you fail to pay the delivery cost, the inventory will be at the what? At the port. And we don't want the inventory at the port. We want the inventory in the warehouse when it will be ready, when it will be available ready, anytime we need it to send it to the customer. So that is also a relevant cost. So every cost that we have incurred from the purchase point down to the point that we are going to be, that inventory will be available in that warehouse that we need it. All those costs will be added together to give us our cost of inventory. So let's go down here. So we have purchase price. So we're gonna, for us to get our purchase price. So our purchase price will now be, we have 1,000 units. 1,000 units times 1,000 units times how much do we purchase? We purchase at 1,200. But are we paying 1,200? No, we are not paying 1,200. We are paying 95% of that 1,200 because there's a discount of 5%. So we say 95 times. Assuming we are paying the total amount of money, we just do 1,000 times 1,2. But because we are paying 95, not 100%, we have to reduce it by 5%. That's why we are multiplying by 95%. Another way around in which you can do it is by doing 1,000 units times 1,000. Okay, you can do 1,000 units times, you want now open bracket, 1,200 times 5%. Then you will now do minus 1,200. That will be a long journey. Well, this is what I'm saying. That another way, instead of you doing this way, is that you can do this and put another bracket, 1,200 minus bracket 1,200 times 5%. Times 5%. But if you do it this way, you are correct. It's just a long way. Okay. So, but let's go back to the previous one. Oh, okay. So let's go back to the previous one. So the previous one says that 1,000 naira times 95 units. Now, if you press the calculator, that should give you a total sum of let's see, press the calculator, 1,000 units times 1, 2, and times 95%. That will give us 1,140,000. Now, that's the amount for that. So import duties. Now, import duties is 60 naira. For how many units? It's per unit, 60 naira per unit. So we have 1,000 units. So if we multiply that together, that will give us 60,000. Delivery cost is what? 5,000. So it's not per unit. So it's the lump sum of 5,000. Now, adding these things together will now give us our cost of inventory, and that's 1,205,000. That's the cost of our inventory. It is this amount that we are going to recognize, or we are going to use to value the inventory under our current assets. So under our current asset, the figure that you will be seeing is 1,205,000. 1,205,000. But if a manufacturing company that is now reduced to working on the raw material, on what you have purchased, you still went ahead to change it into a particular taste for the customer. That's conversion cost. You have incurred that cost in it to convert it from one stage to another stage. That is what we call conversion cost. That cost is relevant. That cost will be added to the initial cost that we have accrued on the material to give you the total cost of inventory. Conversion cost, when material purchased from suppliers are converted into another product in a manufacturing or assembly operation. There are also conversion costs to add to the purchase cost of the material. Conversion costs must be included in the cost of finished goods and unfinished work in progress. So we will have of work in progress or finished it at the moment, maybe stage 1, stage 2, stage 3. Under stage 2, you are done with stage 2, you are not done with stage 3. This conversion cost of stage 1 and stage 2 must be added to the initial purchase cost. So if you are on stage 3, you have to separate it as well. It must also work. We now say, okay, stage 1 plus stage 2 plus stage 3, these costs are added together. It will not be added to the initial cost. It means that the cost of inventory will be at stage 1 will be different from the cost of inventory at stage 2. It will be different from the cost of inventory at stage 3 because there's what the conversion cost in between these stages. Cost. Conversion cost consists of costs directly related to units of production, such as cost of direct labor, fixed and variable production overhead as well is also what is part of our conversion, like maybe let's say generator, diesels, or maybe depreciations, part of it, of what an asset, rent, that is what that is actually solely responsible for the conversion, for the manufacturing, or for the assembly purpose alone, solely for it. It's also what that rent also will be added to it. Also energy, all these fixed overhead that can easily or that can is traceable to the production of the material or the assembly of the product will be also what will be relevant. Other costs incurred in bringing the inventory to the present location and condition. These are the initial one that we calculated. These are the other costs of purchase and bringing it to the present location and condition. All those costs will be added the conversion cost to give us the cost of inventory. Let's look at question 4. KCE. So we work more on what on the KCE example, but we now went a step further. Now, KCE manufacturer control unit for air conditioning system. The following information is relevant. Each control unit requires the following: one component X at the cost of 1,205 units, one component Y at the cost of 800 units, sundry raw material at the cost of 150. The company faces the following monthly expenses: factory rent 500, energy cost to be 7,500, selling and administrative cost. Each unit takes 2 hours to assembly. Production workers are paid 300 naira per hour. Production hours are observed into units of production using an hourly rate. Okay, so they use hourly rate. Okay, the normal level of production per month is 1,000 hours. So which means that the normal production levels, the hours that are allowed to produce with in a particular month is 1,000 hours. It means that every the fixed overhead cost should be apportioned on what? On hours. It means that what? The fixed overhead cost should be apportioned using hours. That's more we talk about in what? In your management information, that's MI. Calculate the cost of a single unit. So we have to calculate the cost of a single unit. So what we are expected to do as an accountant is to bring all related costs for that single unit, bring them together so that we can what? We can add them together and get the total cost that we will incur to get the single unit ready for sales. So we start the work with the component. Component X. Component X and component Y are what part of items used to produce a single AC. Now, so a component X, the cost of it is 1,205. 1,205. So we have that to be what? 1,205. Component Y is another what? Another component, which is what? 800. Then after that, we have what? We have sundry raw material. Now, sundry raw material is actually what? Is another material used. It's an additional material. It's not main material like component X and Y, but there are other materials that are used in producing the AC. That's why they call it what? All the sundry raw material. And that's another example of components. You know, when we started the class, I said raw material and components. So that's the example of component. So we have sundry raw material. So it will be added to it because it's being used. So addition of these three, we give us what? So let's press our calculator and let's see the addition. So 1205 plus 800 will give us 2005. So plus 50, that will give us 2155. So addition together. So now we have done the what? We have done the calculation of the what? Of the material. Now we need to now calculate our conversion cost. That are the costs that we incur to convert the raw material to finished goods. So now if you look at it now, what it costs us? It says that the factory faces the following monthly expenses. Those are the monthly expenses. They have factory rent, they have energy cost, which means the what? The cost they use to what? To run the plants. So they have that. Then I say that each unit takes 2 hours to assembly. So they take 2 hours to assemble that component. So it means that and production workers are paid what? 300 per hour. So it means for us to produce 1 unit, we are going to use 2 hours. 1 unit, 2 hours. And remember, what you are trying to work, you are trying to know the cost of a single unit. So we put what we come here under our labor, to put the bracket here. So we have 2 hours. So how many hours you use to assemble? We have 2 hours. Okay. What is the cost of that 2 hours? They give us that 3 hours per hour. 300 naira per hour. So we have it times 300 naira. So we multiply this together, it give us 600. After that, we have our overhead cost. Now, overhead cost, they give us an information that the overhead cost is based on what? That we should apportion, we should absorb. Because that factory rent and energy cost is not solely for the production of what? For the production of for production of AC. Part of it goes to the admin. Admin people also what are part of it, and admin expenses is found under profit or loss, under what? Under the trade account, profit or loss account. So admin expenses will not be found under this, will not be added to it, because either we produce or not, we are going to what? Pay rent. And that also, either we produce or not, we are going to earn gen for the people in admin to work. But they now say this admin and factory are sharing things together. So we should absorb it using what? Hourly what? Using the hours that be apportioned for the month. It means that if my hours is 1,000 hours, then let me, what is the total cost what is the total factory cost or other cost per hour? I need to calculate that. Then I will now use to multiply the total hours for my machine. So the first thing is that I need to know the cost. I need to know the cost per hour. I need to know the cost per hour. So how did I get that? So you come down here of overhead cost. So you had all the overhead costs together that are relevant to the production of AC. So 16,000 factory cost. Without that, we can't produce. Plus 75 energy cost. Also, selling and administrative costs will not be added because it is not what directly related to the conversion of what or assembly of the components. It is after they finish assembling the components that they will now make sales, and from there they will now what incur the selling and the administrative costs. So we now have divided by 1,000 hours, because they told us that what? That we should absorb production overhead are absorbed into unit of production what? On hourly rates. So we absorb it. Once we do that, what the answer that we give us is the answer that regarded to what? Is the cost per hour. The cost per hour. So now let's multiply this. Let's add it together. So we have 16,500 plus 75. That's 24,000 divided by 1,000. That gives us 24, which means that what? On 1 hour, we cost 24 naira. 1 hour will cost 24 naira. Now, in that say that, but the additional information given us before earlier on say that what? They only need 2 hours. They only use 2 hours to assembly what? One AC. So we now say times 2. times 2 hours times 2 hours. Now, if 1 hour is 24, then 2 hours will give us what? 24 times 2, which is what? 48. Now, once we are done with that, we now add it together. So let's add 215. 2155 plus 600 plus 48 will give us a total sum of 2,803. 2,803. So we are good to go. So which means that we have been able to address that, the cost, that this is the cost of our asset, 1 unit of the asset. So if we produce 10, it will be times 10. If we produce 20, it will be times 20. Now, when I started valuing valuation of asset, I said that the lower between cost and net realizable value. Now, we have looked at cost. The next thing is now to look at what our net realizable value. What do we know about NRV? Now, according to IS2, net realizable value means the estimate selling price in the ordinary course of business, is not a cost of business, cost of completion, and less cost necessary to be incurred in order to make the sales. Now, this is what it's saying. If I have an item, I've worked on it, one stage 2. When I'm done with stage 2, it's not finished yet. I still need to do stage 3. So I have to, okay, what is the market price? The market price is saying 20,000. Are you with me? Now, if market price is saying 20,000, but I have not completed it, so I need to reduce the 20,000 with what? The cost of I'm going to use to complete it. No, I'm only left with one stage. So I'll say if stage 3 is 3,000, then I'll now say 20,000 minus 3,000. Then also, I'll now less the cost that I will incur to make the sales. For example, probably I will need to employ sales team. So I'll need some sales team to dispose the assets or transporting the asset from one point to another point. Those are the example of cost of sales. Now I need to reduce my selling price by what? By the cost of sales. It is this net figure that I'm going to use to compare with my cost, my initial cost I've calculated initially. I will now compare the two together. The lower between these two is what will give me, is what I'm going to use to value my inventory. Is what I'm going to use to value my inventory. Please, a minute, please. Thank you. So it's what I'm going to use to value our what? Our inventory. So now, net realizable value is the amount I can obtain from selling the inventory in the normal course of business. It means fair value. That's what if a buyer and a seller comes together, the amount, the price they can agree on, the price that they can agree on. That's the selling price that we're talking about. Less any further cost that will be incurred in getting it ready for sales or disposal. Getting it ready for sales or disposal, or for both. Sales is that, okay, I'll need to do 1 or 2 things there, but I'm not ready to do it. Okay, what is the cost that I'm going to incur if I want to do it? Okay, minus it from my what? From the market, people that have done it before, minus from the market. Okay, the difference, take it. For example, you have a phone. You have a phone that have screen issue. When the phone have screen issue, okay, you can repair the screen and sell it, or you can just dispose it like that. Okay, what is the market value of the one that have good screen? Is 20,000. What is the screen? The screen is 5,000. Okay, 20,000 minus 5,000 is what? Is 15,000. It means that the amount I'm going to sell my phone is 15,000. That means that the minimum amount of money I can derive from my phone is what? Is 15,000. That's what they're talking about. But if they are going to now give the phone to someone, that person will sell for you, and you're going to pay that person, let's say you're going to pay that person 1,000 naira, and it means that your net realizable value will now be 20,000 naira minus the selling price 20,000 naira minus the the cost of completion of repairing the phone, which is 5,000, minus the cost of sale, which is 1,000. Then it means that what the net your NRV will now be 20 minus 15 minus 5 is 15 minus 1 is 14. It will now be 14,000. It will now be 14,000. So is that 14,000 you are going to compare to the cost, the initial cost that you have calculated or you have seen. Now, this net realizable value is being done on what? That's what we call subsequent measurement. It means that over time, you have to check if the amount that you have carried your inventory is actually is reasonable. If you have not overstated your inventory, because overstating your inventory, like I said at the beginning of the class, will affect your profit. So now let's look at our illustration, a short one. It says that a business has a business has 4 items. Sorry, change that to be 2. It's 2 items. So a business has 2 items of inventory. A count of what? A count of the inventory has established that the amount of inventory going at cost are as follows. So they gave us inventory item A and B. They give us A and B, and they give us the cost, the sales, and the what? And the sales price and the selling cost. Now, this is what we're going to suppose. We come down here to the table. We have A, we have B. So for A, the cost is 10,000. And the sales price is what? 8,500 minus our selling price. We're trying to get our net realizable value. So this one will give us what? Equals net realizable value. Okay. So that was minus what? Selling price is what? 500. And that will give us a total sum of 8,000. It's a total sum of 8,000. So this one is what? It's 14,000. And that is what? 16,000 minus 200. That should give us 15,800. Now, we have our what? Our cost. We have our NRV. Now, we need to check the two together. If our cost is 10,000, our NRV is 8,000. It means that the lower figure is what is the net realizable value. Is that 8,000, our records, our current assets under our financial statement will be valued at 8,000 as against the 10,000, because the law says that what? The lower between the cost and the net realizable value. Therefore, B item B, the cost is 14,000. Why the what? Why the NRV is 15,800? So the cost is lower. So it means that we are going to pick the cost of the item, not the net realizable value, or what? To value our inventory in our financial statement. Now, there are cost formula. Cost formula is such that what? It's not based on the assumption that what material are being purchased. So it means that cost formula, that how do we handle our inventory? How do we treat our inventory? Is the item that comes in, item or the item that goes out? So that's what that cost formula is talking about. So how do we handle our inventory? What are the formulas? Now, according to the standard gave us 2 options that we can also use FIFO or weighted average to cost our inventory, because the one that we have done over time, the cost and the net realizable value is what? If you have just single transaction. But now let's look at, for example, you purchase an item worth 10,000. You purchase a pen worth 10 naira. You went to the market, you purchased the same pen 15 naira. You went to the market, you purchased another pen, the same pen 20 naira. So how do you account for it? How do you account for it over time? How do you know that, okay, this is because the cost that you are using to recognize your inventory is the same cost that you are going to use to take it out from your inventory. So the question is, how do you do this? That's why the cost formula comes in. That first in, first out, FIFO. Means that what? The first item that goes into your inventory account should be the first item to leave your account. First in, first out. So if I have a transaction that have like we have a particular inventory, let's say a pen that we used earlier on. So, but I have like 3 transactions on the what? On inventory. A 20, B 30, C 50. If I want to issue out, I have to issue out the 21st before I issue out to what? Before I issue out 30 or before I issue out the 50. It means first in what comes in first should be the thing that goes out first. And it actually helps to what? When it comes about fluctuation in what? In price. Because if you have an expensive item in your warehouse, you have an expensive item in your warehouse, and you now purchase a cheaper one. If you don't use the expensive item, it will continually work, and the price keeps reducing. Once the price keeps reducing, it will affect what? It will affect your cost of sales. Because your cost of sales will be high, it will drop your what? Your profit. You won't be able to do business as appropriate again. So it means, well, if it's expensive, you have to use it on time. Because if you use it on time, you'll be able to order your competitor also have the expenses inventory. So when you use it on time, you'll be when your competitor now start dropping price, you'll be able to drop price because you have another inventory that you have purchased at a lower cost. So that's one of the advantage about FIFO. So let's look at account for FIFO. So FIFO on question C is the following is the record of receipt of certain material during the month of January 2006. So January 2, we received item of 500 units at 20 naira per unit. For January 3rd, we received 400 units at 21 per unit. January 15, we received 300 units at 19 per unit. January 28, we received 400 units at 20 per unit. During the month, it sold 600 units as follows. So January 5th, they sold 100 units, and January 17th, they sold 500 units. So compute the inventory value on 31st January 2006 by FIFO method. So we are asked to compute this using FIFO method. So how do we do that? So let's see. So we normally have what? We have three tables. We have the receipts column. The receipts column is when we are receiving items. This is the receipt column that we have here. Receipt column is what? When you are receiving items. So it is formed under this. When you are making purchases and you are receiving, it's formed under this head. Another one that we have there is issued. The issued is as a result of what? The issued is as a result of you. The issue is as a result of you issuing out, giving out, making sales to customer. That's issued. Or you returned anyone. That's issued. And that one is balance. Balance is what you have what at a particular point in time. Under the perpetual, this is actually what this is an example record keeping under the perpetual method. You show what? You show the value when you receive it, when you issue it, and at a particular point in time, you can ascertain the balance of the inventory. So now let's go for the first date. So we have January 2nd here. So we are putting on that date here. So we have January 2nd. So we put it on that date here. So we come here and we put, okay. So we put January 2. So we put January 2. When we put January 2 there, we have that to be quantity. So quantity, what is the quantity that we purchased in January 2? So we have that to be 520 naira. So we put that to be what? 500 units as what? As 20 naira. That's the what? 20,000 times 500 will give us 1,000. So then you go to balance. When you go under balance, what do? You put your quantity because there is no opening balance given to us. So we put quantity at what rate? 20 at what? 1,000. You multiply the two, give us what? 1,000. So you go back to the question given to us. The questions on January 3rd, we also receive another item, 400 units at what? At 29 naira. So we have January 3rd. Okay, so I have that to be January 3rd. January 3rd, 400 units. at 21. So if we multiply 400 by 21, if we multiply 400 by 21, that will give us 8,400. If we multiply that, it will give us what? 8,400? 8,400. So now for the balance now, for you to get the balance under quantity, you now look at, okay, you have 500 as our January 2nd. Now 400 have been added to it. It will now be 500 plus 100. That will give us 900. Now the first time we went to market, we purchased it at 20 naira. But the second time we went to market, we purchased it at what? At 24 naira. So at 21 naira. So for us to be able to ascertain and to remember the amount, because FIFO, it means that we need to know the price that we enter the first one, because it's that same price that we are able to use to issue it out. So best thing for us to do is now 20, we put the 20 there, the one that is existing before, slash 21. If we have this, it means that we have two different consignments that have two different price. That's what it means. Then you now come back to what? To the Naira sign. You now say 1,000 plus 84. 1,000 plus 84 will now give us 9,400. When we are done with that, we now move on. So January 5th, there's no January 5th yet. So we have January 5th to be what? We issued out. We make sales. So when we make sales, so it means that we need to what? Our inventory have reduced. So we make sales. So we come under this column issued, because our inventory, we issued inventory. So what is the total quantity that we issued? 100. Then we look at what price. They didn't tell us at what price to what that we issued it. But for us to know the price, what we need to do now, okay, what price do we take it in? At what price do we really accept it? We really absorb it in. The price that we absorbed it in is what? Is 20. Going by what? By January 2nd. January 2nd is 500. January 2nd, we purchased 500 units at what? At 20,000. So out of that 500 now, we are taking 100 units. So we are going to value it with the same value of that 500, which is 20 naira per unit. Now, 100 times 20 will now give us what? 2,000. So you come down here. 900 minus 100, that's 900, what we have before. The 100 that you have issued, it will now be what? 800. Then that's 20. You have only taken 100 out of the 500. It means that the 20 consignment is still in existence. So you have to put what? 20, because you have 400 units that the value at 20 naira per unit. So you show it there. Then 21. Then that be 9,400 minus 2,000 that you have what? The cost which you have issued out will now be 7,400. Now this means that as at the end of January 5th, the value of our inventory that we have in our warehouse is what? 7,400. After we are doing it, we now look at what is the nearest date to what? After January 5th. We now look at it. Okay, the nearest date is January 15. January 15. Now, January 15 is we received, we make purchases. We make purchases of item worth 300 units at what? At the rate of 19 naira per unit. So if we multiply this together now, 300 units times 19, 300 units times 19 naira. That will give us a total sum of 5,700. Now, under the balance, 800 units, we have 800 before. We have added 300 to 8. So 800 plus 300 will give us 1 units. Then we come down here. So under this space, we have what? We have 20 is existing before. 21 is existing before. Then we have added a new one, which is what? 19 to 8. So it means that whenever we are issuing out, we have to issue out 20 first before we can move to 21, before we can move to 19. So we now have the balance to be what? 74 plus 5,700. If we add them together, that will give us 13,100. 13,100. So we move on as well So the next date that we have there is what? We have January 15, 28, 17. 17. That's we make sales in January 17. We make sales in January 17. And what is the sales that we make in January 17? We make sales of 500. 500. Now, we have how many consignments in our balance? We have three different consignments. We have the one that is valued at 20, we have the one that is valued at 21, we have the one that is valued at 19. So now the question is, how do we, what is the total quantity that that is left for the one that is valued at 20? We've purchased 500 units at 20 naira per, and we have issued 100 out of it. It means what is left on that 20 is what? Is 400. 400 at what? As 20 naira. But the total sales that we make is what? The total sales that we make is not 400. We make a total sales of 500 units. So which means that we need to balance the sales by 100. That 100 will now be taken from what? From another one that is next to it, because we are done with 20. So we move to what? To 21, the one that we bought at 21 naira per unit. And that's the one that we bought 400 quantity at 21 naira per unit. So which means that this one now, this 100 will be valued at what? As 21 naira. As 21 naira. So after we have done that, then we now press calculator. 400,000 times 20, 400 units times 20,000 will give us what? Will give us 8,000. 100 times this one will give us what? 2,100. Now, for us to not get our balance, will now be 1,100 minus 400 minus 100. 1,100 minus 500 minus 100 will give us what? A sum of 600. Now, at what value? We have exhausted the 20, the one that we purchased as 20 naira. So we are left with one that what? 21. 21 or what? 300 units of this 21 slash what? 19. Then the balance now be what? 13,100 minus 8,000 minus 21 will give us what? 3,000. It give us 3,000. Now, if we look at this one now, the next one is now what to do? January what? January 28. January 28. And we purchased. So we receive our quantity into our warehouse, 400 at 20 naira. Now 400 at 20 naira will give us a total sum of 8,000. 8,000. Now the balance there will now be what? 600 plus 400. That will give us what? 1,000. 1,000. So that's 1,000. So then we have 21 existing before plus 19. After that, what else we have? We now have a fresh one at what? As 20. We have fresh one as 20. So we put it there. So we now see 3,000 plus 8,000. We now give us what? 11,000. It means that at the end of what? January, that was the last transaction. At the end of January, the total inventory that we have in our record is what? Is 11,000. That 11,000 is what will be showing in our what? In our current asset. So you buy item, but it's just ones that you buy. Is the cost of that single asset that you purchase that will be what? That will be reflecting in our inventory account. That will be reflecting in our inventory account. So we have LIFO. LIFO is actually the opposite of FIFO. LIFO means that what? Under this method, is assumed that the material goods purchased in the last are issued at first. So it means that what you are buying last is what we are issuing at first. But it's not good. It's not a good one for what? For the inventory. It's not actually listed in the standard. I just added it there. What is listed in the standard says FIFO and weighted average. But this one is actually what? It's not too good for the system, because if we have a perishable item and you bought a perishable that with something that will last for you for one year, and you see you added more to it, and you are taking out of the one that the fresh one that you have added that have more longer lifespan compared to the one that you have bought earlier. There is probability that that the one that you have bought earlier will expire in the warehouse. So that's why LIFO is not it's not the good inventory system. It's not a good inventory cost formula to use. So we have that LIFO, that was first and last in, first out. So another one that we have is is weighted average. Under this method, the quantity of material purchased in various lots of purchase is considered as as weight while pricing the material. Weighted average, it means that what is the total weight of the inventory divided by the quantity, so that we can we can just find, okay, this is the total weight. Then let us know okay, on an average basis, what will be the cost of one inventory. So the cost of that one inventory will now be used to to issued items out. It will now be used to to issued item out. So because of our time, and I don't want us to take into I don't want us to take too much of time. I want to stop 11 so that I will not be penalized. So I'm going to stop the class here today. So from next class, we're going to start on question 7. So, but you can also practice question 7 on your own. But next class, we're going to start from question 7. Then we'll move to IS1. Then we start our financial statement. That's when we now start preparing financial statement. All what we have been doing so far is adjustment, because all these adjustments will come under your additional information, like I do say. So what we are doing now is for us to to now effect that going forward. So if you have any question, please, I would like to answer the question. Let me check my chat. If I have any question, there is no question on my chat box. Oh, no question. No question. Okay. But if you have any question, like I do say, please, I will advise you should start reading. There's a possibility that the exam will take place either July or August. There's high possibility that the exam will take place either July or August. So you need to start reading now, like your exam is tomorrow. So that if you start reading as if that you are going to write the exam tomorrow, because it will help you a lot. I noticed that I have not been having questions, and I don't want to believe that I actually I explained everything like that. So I'm expecting question, please. I am expecting question. Please ask question when there is need. Okay, so in the absence of question, no question, so I would like to wish you a lovely night rest, and we shall continue from where we stop next class. Thank you for your time. Goodbye.